Okay, everyone, welcome back to the channel. Today, we're tackling a big one that confuses so many of us independent professionals, GST. If you're a freelancer, a consultant, a designer, a developer, a marketer, working from home, serving clients both in India and maybe even abroad, you've probably scratched your head about this. Do you need a GST number? What about clients outside India? How do you handle getting paid in dollars? Sounds familiar? Well, today we're going to break down the goods and services tax, or GST, specifically for you, the amazing freelancer and consultant community here in India. We'll cover everything you need to know to stay compliant, understand your rights, and yes, maybe even get some tax back. First things first, who actually needs to register for GST? The basic rule under the law is this. If your aggregate turnover from supplying taxable services crosses a certain limit in a financial year, you must register for GST. What's that limit? Generally, it's 20 lakhs rupees. Now, for some special category states, this limit is 10 lakhs rupees. Okay, that's the basic rule. But here's a quick point. Sometimes, even if you're below this threshold, you might still need or want to register. Why does this happen? Maybe you are providing services to clients in another Indian state, interstate supplies. Although there's a specific exemption for service providers below the threshold here. Or maybe you want to claim input tax credit, what we call ITC, which is essentially getting credit for the GST you pay on your business expenses. Or, very importantly, if you plan to export services outside India. Another big reason, your corporate clients might require a GST compliant invoice from you. So, even if it's not mandatory, voluntary registration is an option. Let's take a moment here. If you register voluntarily, remember that all the compliance rules kick in. You have to file returns and follow all the procedures, even if your turnover stays low. Now, let's talk about your clients. Serving clients right here in India. When you provide services to Indian clients, GST typically applies. The standard rate for most professional services is usually 18%. You might see service accounting codes or SAC codes like 9983 for other professional services or 998314 for IT design and development on invoices. As a freelancer, you need to collect this GST from your client and then pay it to the government. Your invoices are super important. They need to follow specific rules. Think about this. Every invoice must have details like your name, address, your shiny new GST, the invoice number and date, a clear description of your service, the SAC code, the tax rate, the amount, and the place of supply. If your client is a registered business, a B2B client, you must capture their GST on the invoice so they can claim ITC. You might have seen this happen in real life. Let's quickly recap. Indian clients mean GST applies usually 18%, you collect it, and your invoice needs specific details, including the client's GST for B2B. What about serving clients around the world? This is where it gets interesting. When you provide services to foreign clients, it can often qualify as an exporter services. If it qualifies, it's treated as a zero-rated supply. What does zero-rated mean? It means no GST needs to be paid on the service you provide to the foreign client. Big relief, right? Plus, you can claim a refund of the input taxes you paid on expenses related to that export. But there are conditions for a service to be considered an export. Here are the 5 key things that must be satisfied. 1. You, the service provider, must be located in India. 2. The client must be located outside India. 3. The place where the service is considered to be supplied must be outside India. 4. The payment you receive must be in convertible foreign exchange or Indian rupees permitted by the RBI. This is a crucial one. What if a foreign client pays you in INR via something like PayPal? That usually does not qualify as an export, and it could be treated as a domestic supply liable for GST. 5. You and the client shouldn't just be different branches or establishments of the same legal entity. Let's take a moment here. These 5 conditions are vital. If even one is missed, it might not be a zero-rated export. Okay, so how do you actually do this zero-rated export? There are 2 main ways. 1. Export under a letter of undertaking or LUT. You submit form RFD 11 on the GST portal. With an LUT, you export without paying IGST upfront. The big advantage? It avoids blocking your working capital. You can then claim a refund of any unutilized ITC. This LUT is valid for the financial year and needs to be renewed annually. Yes, even if you only have foreign clients, you need to maintain and renew your LUT annually if you want the zero-rated benefit. 2. Export with payment of IGST. You pay the IGST when you make the supply. Then, you claim a refund of the IGST you paid later on. For exports, your invoice wording is different. It should clearly state something like supply meant for export under bond or LUT without payment of IGST or supply meant for export on payment of IGST. You also need to mention the foreign client's name, address, and indicate the place of supply is outside India. Now, think about this. You also need proof that you actually received the money in foreign currency. Documents like a FIRC, Foreign Inward Remittance Certificate, or a bank realization certificate are essential. Why? They prove it's a genuine export and help with refund claims. Here's another quick point. The money must be received within 1 year from the invoice date. If a foreign client delays payment beyond 1 year, you could become liable to pay GST along with interest. So, keep an eye on those payment timelines. Claiming refunds. If you export under LUT and have accumulated ITC on your expenses, or if you paid IGST and want it back, you need to claim a refund. You do this using Form GST RFD01. You'll need supporting documents like your invoices, FIRCs, and a statement of your export invoices. This must be filed within 2 years from the relevant date, which is usually the date of export or when you received payment. Let's quickly recap. Serving foreign clients can be zero rated if specific conditions are met, especially getting payment in foreign currency. You can export without paying tax upfront using an LUT or pay IGST and claim a refund. Proper invoices and proof of foreign payment are a must. Okay, what about input tax credit or ITC? Can freelancers claim it? Yes, absolutely. This is a big benefit. You can claim ITC on goods and services you use for your business. Think about your laptop, internet connection, software subscriptions, co-working space rent, other business utilities. If your bank charges GST on things like currency conversion or SWIFT charges when you get paid by foreign clients and gives you a GST invoice, you can claim ITC on that too. However, there are some things you cannot claim ITC on called blocked credits. These include personal expenses, food and beverages, or capital goods used for services that are themselves exempt from GST. To claim ITC, you need proper tax invoices from your vendors and you must have paid them. Now, let's talk about filings. Once you are registered, whether mandatorily or voluntarily, filing returns becomes essential. You likely need to file GSTR1, which is your monthly or quarterly statement of outward supplies, your sales invoices. Then there's GSTR3B, a monthly or quarterly summary return where you declare your tax liability and claim ITC. There's also an annual return, GSTR9, but only if your turnover is above 2 crore rupees. Here's a quick point. Even if you have no domestic clients and only export services, meaning no GST collected, you still need to file nil GSTR1 and GSTR3B. Don't forget this. What if you forget to file GSTR1 or GSTR3B on time? You'll face late fees. It's 50 rupee per day, but only 20 rupee per day for nil returns. There's a maximum limit too. Also, if you had a tax liability and you delayed payment, you'll have to pay interest at 18% per year. You might have seen this happen in real life to someone you know. Let's quickly recap. You can claim ITC on most business expenses, but watch out for blocked credits and regular return filing, GSTR1, GSTR3B, GSTR9 if applicable, plus nil returns is non-negotiable once registered. What about platforms like Upwork or Fiverr? You might be using these to get foreign clients. These platforms are often intermediaries. They might deduct their service fees. However, you are responsible for GST compliance on the entire consideration, the full amount the client paid for your service, not just the amount that lands in your bank account after platform fees. Good news though, if the platform charges you GST on their service fees and gives you a GST invoice, you can claim ITC on that. Can freelancers use the composition scheme? Generally, no. The composition scheme is mostly for businesses selling goods or restaurant services. However, there is a special composition scheme for service providers with turnover up to 50 lakhs rupees where you pay a flat tax of 6%, 3% CGST plus 3% SGST on your turnover. Most professional freelancers providing services would fall under the regular scheme, not the standard composition scheme. Now, think about this. What if a client pays you in advance for a service? For services, GST is usually payable at the time you receive the advance, not when you actually issue the final invoice or complete the work. You must issue a receipt voucher when you get the advance and later adjust it against your final tax invoice. Finally, just to reiterate, if you are registered under GST, issuing a proper, compliant tax invoice for every service you provide is mandatory. So, to wrap it up, registration is key, usually needed above 20 lakhs rupees turnover or 10 lakhs rupees, but voluntary registration has benefits. Domestic clients mean GST is applicable, collect and pay it. Foreign clients mean potential zero-rated export if conditions are met, especially receiving payment in foreign currency. Use LUT to export without paying upfront tax and claim ITC refund, or pay IGST and claim refund later. Remember the 1-year payment rule. ITC can be claimed on business expenses, but watch out for blocked credits. Regular GST returns, GSTR1, GSTR3B, are mandatory once registered, even if they are nil returns. Keep invoices and remittance proofs properly. Understanding these basics will really help you manage your finances better and grow your freelance business without compliance headaches. I know this is a lot of information, but it's super important for all of us building independent careers. If it's still confusing, listen to this part again. Now you know what most people don't. Share this with someone who needs to know. maybe another freelancer friend or consultant. Stay compliant, stay profitable. See you in the next video.